Hello, everyone, and welcome to our halftime report. We have a lot of people inside of the webinar tonight. I'm going to try to move quickly. I know I say that every time, but thank you all for joining us. I think tonight will be educational. Obviously, a lot of you have seen some wonderful things happen inside of your accounts over the last 48 hours. I will unpack that a little bit. But let's go ahead and let's jump into it. First thing that I'll start with is some disclosures. As you all know, Triumph Capital Management is a registered investment advisory firm with the Securities and Exchange Commission. The views that I will share here this evening are my own. They may not necessarily be the views of whom you work with at Triumph Capital Management. I will also be making some forward-looking statements. In those forward-looking statements, those are opinions. I will unpack further disclosures as I unwind things here this evening. We do this presentation sometimes in person. So as you can see, there is a slide that asks to silence your devices. Again, welcome. For those of you inside of the webinar who do not know me, my name is Derek Eichenwald. I have the distinct pleasure of serving as Triumph Capital Management's CEO and senior investment executive. If you hear an accent, I am originally from Massachusetts. I have been in the business for approximately 23 years, and I'm really happy that you could all join us this evening. As far as the agenda, what I will focus on tonight are some key areas. First, I'll review the first half of the year. I'll take a look at potential market forces in the second half of the year, and I'll provide for you an outlook. We'll ask, where are we now? And finally, I'll give you what we see ahead for the second half of 2024. So here's a snapshot of the S&P 500 index, its performance from the first of the year until the end of May. The S&P 500 notched a solid gain. It was supported generally by positive Q1 earnings. Earnings inside of companies were very good, and that's what somewhat propelled the market during the first half of the year. There's all this talk about AI and AI changing productivity. The first half was marked really by those three kind of themes: AI enthusiasm, inflation fears waning, and Fed signals of a rate cut. I'm going to unpack those more as we kind of work through tonight's presentation. So at the beginning of the year, we look at some of Wall Street's major firms and we ask them for predictions of what things will look like at the end of the year. And if we go back to December 31st of 2023, here's what some of Wall Street's major firms predicted that the S&P 500 would be at come the end of the year. Just by way of comparison, the S&P 500 closed December 31st, 2023 at 4,770. So here are the predictions by some of Wall Street's largest firms. And as some of you may know, today the S&P 500 closed at 5,667. If you look at the group average believed that we would close the year someplace around 4,817, off from where we closed today by about 17%. So a huge miss, at least thus far. Next on the screen, as of the close of business Friday, you can see what the major indexes have done. The NASDAQ up 20.77% as of the close of business Friday. The S&P 500 up 17.72. The Russell 2000, which tracks smaller size companies, up 6.76. The Dow Jones Industrial Average, which tracks 30 of America's largest companies, up 6.12. And the S&P 500 equally weighted. I'll unpack what I mean by equally weighted in a moment, up 10.74 as of the close of business Friday. We look at that stock group average, it comes out to about 12.5%. The S&P 500, I'll circle it there, and the equally weighted. What do I mean by those two things? Well, everybody knows that the S&P 500 is supposed to represent 500 of America's largest companies. Those are represented by 11 different segments or sectors of our market. Those sectors include technology, communication, utilities, financials, energy, so on and so forth. But what I mean by equally weighted or non-equally weighted, when you see the S&P 500 on TV or you pull it up on a website, so on and so forth, what you are noticing is you are noticing the S&P 500 as we all understand it. But the S&P 500 is not equally weighted. By the way, before I go on, that was the performance of each sector. You can see real estate being the worst performing sector, up 1.5% as of the close of business Friday, while technology was the best performing sector, up close to 22%, followed by communications. Here's what I mean. If I ask people what are technology companies, people will typically say to me, Apple, Microsoft, Intel, and they would be correct. If I say to them, what are communication companies, people may say to me, AT&T, Verizon, what have you. But what a lot of people don't know is where do places like Google, who owns YouTube, if you think about it for a minute, Facebook, who owns Instagram and Reels and things like that, Meta platforms, where do they fall in? They fall into that communication services sector. So when you look at the S&P 500 and you look at it in the newspaper, you look at it on TV, realize that energy only represents 3.5% of the S&P 500. Materials only represents 2.2. You'll notice on my screen that I've circled tech and communication services because they are so much related. And if you add those two components together, the S&P 500 that you see on your computer screen, the S&P 500 that you look at in the newspaper, it's about 42% inside of basically tech. Interestingly enough, that tech sector, if you will, you've probably heard this on TV, you've probably heard this in the newspaper, the Magnificent Seven. Who are the Magnificent Seven? The Magnificent Seven are Apple, Google, Facebook, Microsoft, NVIDIA, and Tesla. Google's in there twice because they trade under two separate tickers, so that was only 6, but you know they call it the Magnificent Seven. Well, what this graph is showing you is the Magnificent Seven, whom represent the top technology stocks in the S&P 500. On the left-hand side, we break out the performance of the Magnificent Seven and the S&P 500 while excluding the Magnificent Seven. While the Magnificent Seven stocks have dominated the market performance in 2023, these 7 stocks severely underperformed in 2022, highlighting their greater volatility. For instance, if you look at the graph on the left-hand side, look at that green bar. This data is as of the close of business on Friday, but what you will notice is if you look at the S&P 500, which I just got through telling you was up wonderfully for the year, but if you strip out just those 7 stocks, the S&P 500 is only up 7% for the year. If those 7 stocks existed by themselves, they'd be up 38% for the year. On the top right, we look over the year-over-year earnings of the growth of the Magnificent Seven, and we exclude it from the S&P 500. And after contracting in 2022, as you'll notice inside of that graph, the Magnificent Seven grew strongly in 2023, and their earnings, just blew it out of the park as we got into 2004, so on and so forth. And so, interestingly enough, people like to say the S&P 500 is this diversified 500 stocks. It's not. If we simply strip out those 7 companies, look at where the S&P 500 ends up. only 7% for the year. So it's just quite amazing. I go to point that out. If I flip the script for a second and I talk about the bond market, where are we with bonds year to date? Investment grade bonds, as you can see, up only about 1%. US Treasuries up about 0.5%. High yield or junk bonds up about 4%. TIPS or Treasury inflated protected securities up about 2%. And municipal bonds up about 0.5%. The bond market group average up about 1.5% thus far this year. If I go across the pond for a moment, I'll look at frontier markets, emerging markets, and developed markets. Now, for some of you inside of the webinar tonight, you're like, frontier markets, I've never heard of them. Listen, we've been calling emerging markets forever. When will they no longer be emerging markets? Well, what we tend to do is we tend to separate out those emerging markets and frontier markets. Emerging markets basically are China, India, Brazil, South Africa, so on and so forth, where frontier represents places like Vietnam, kind of today's emerging market. Well, what you can see is frontier markets were up about 8% for the year. Emerging markets were up about 12%. In developed international, which would be places like Europe, up about 10.5%. So overseas, things are doing pretty well, just as they are here. And remember, these numbers are just as of Friday. This doesn't include the last 2 days. One thing that I like to point out, for those of you who know us, you know that we like to show you this chart. But for those of you who don't know us, let me unpack this graph for you. What you're looking at here is you're looking at the S&P 500 from 1980 until the close of business on Friday. The gray bars represent what the index did, what the S&P 500 did in each particular year, whether it was up or down. In other words, in 1980, and I say 1980 simply because it's easy on the eye, it's the first year here, you'll notice that the S&P 500 was up 26%. If I go to 1981, that gray bar, you'll notice that the S&P 500 was down 10%. The red dots are simply indicating at any particular time during that year, at one point, what the market was down. For instance, although the stock market, the S&P 500, ended up 26% positive in 1980, at one point it was down 17%. This year, as of the close of business Friday, S&P 500's up approximately 18%. Don't forget, at one point this year, we were down 5%. That's the first thing that I want you to notice. The next thing that I would like you to notice is that when we do have down markets inside of the S&P 500, they are very short-lived. When I say they are very short-lived, the average bull market runs for about 75 months. The average bear market, meaning a down market, on average runs for about 17 months. They're very short-lived. Things tend to snap back. What you noticed here, this 3-year of consecutive loss, this was obviously after the dot-com bubble burst. But even when you got into the 08-09 financial crisis, and when you got into the 2022 interest rate rising environment led by the Federal Reserve, causing markets to kind of go down, that was also very short-lived. So bear markets don't last long. I'll flip this for a second. The graph that you're looking at now is the Bloomberg Aggregate Bond Index. It is no different than what I just showed you with the stock market, but it is now looking at simply the aggregate bond market. And no different, those gray bars represent positive rate of return or negative rate of return. And those red dots represent at any one period of time what that bond market was down in any particular year. All right. Let's talk about the second half outlook and market forces. So the first thing that I'll show you is for some of you who attend these webinars, for some of you who watch these webinars, after it, so on and so forth, you know that we show you our economic speedometers. And to create some context about where the economy may go in the second half of the year, I want to kind of start by looking back at January of 2022, which is what you can see on my screen. We picked January of 2022 as a reference point since it represents a moment in which the pandemic was mostly in the rearview mirror and the speedometers, as you can see, were mostly green. Now remember, 2022 was a historically bad year in the market. It was the worst in century for bonds, in the first time in the history of the markets where you had both the stock market and the bond market down. In fact, the S&P 500 was down approximately 25%. The NASDAQ was down 33%. And the bond market ended up the year down 13%. But look at the economic speedometers, January of 2022. Let's fast forward to where we are today, January of 2024. Just 24 months later, when you look at it, the 3 to 6 month outlook, economically speaking, look at it, it's not nearly as rosy. And despite those interest rate hikes to historic levels in the first half of 2023, in the second half of the year, the Fed started slowing down that pace. And as you can see, 17 of the indicators were neutral at the start of the year, while some of these slipped to red. If I flip this to June, look at it now. We do have some things that are back in the green. We have other things that are in red, and we have some things that are still in yellow. You'll see why this is such a mixed bag of goods in a moment, especially as I start to unpack the economic data for you, which I think you'll really enjoy. And yes, I'll make comment of what's gone on in the markets over the last few days here in a moment, and I'll make sense of it. The first thing to realize is one of the biggest things when it comes to stock market performance is corporate earnings. Most of you have heard me say this. When you go to invest money, when you go to buy anything, whatever you do in your profession, or if you're the person who does the grocery shopping in your household, you intuitively know the price of things, right? You intuitively know the price of things. Every now and again, I'll get a call from a client and they'll say, hey, Derek, I want to buy Tesla, or hey, Derek, I want to buy, name the stock. And I'll ask them why. And they won't, not all the time, but most of the time, won't really have a good rationale as to why they want to buy it, except for they've heard that it's doing well. In fact, when the whole Bitcoin craze was happening, my phone rang unbelievably a large amount of times from clients who never do that with the stock, asking me if they could buy Bitcoin. I digress, but my point that I'm trying to make here is at the end of the day, regardless of what's going on in Russia, regardless of what's going on with the price of oil, regardless of what's going on with politics, regardless of what's going on with inflation, at the end of the day, one of the most important drivers of stock performance is how much money that they've made. Publicly traded companies are required to report their earnings 4 times a year. One of the reasons why they are required to do so is that you as an investor, can make an informed decision to invest in that company or to not invest in that company. What I was alluding to earlier about you knowing the value of something, what you'd be willing to pay for a t-shirt or a can of tuna fish. You know, if you go grocery shopping once a week, you kind of know what the price of bread is. I don't go grocery shopping once a week, or I don't do that in my household, but I'm willing to bet you the loaf of bread does not cost $25. If you walked into the grocery store tonight and a loaf of bread was selling at $25, in your mind, you would immediately say, it is overpriced. I'm not buying it, right? Granted, if you walked in there tonight and a loaf of bread was a penny, you might perceive that as underpriced, and therefore you may buy more of it. Well, when companies report their earnings on average, publicly traded companies trade at 16 and a half. It's really 16.7, but 16 and a half times earnings. In other words, if a company says, hey, this year we made 100 grand, the value of that company on average would be $1,650,000. How much are you paying to acquire the shares of that company? If that PE ratio, price divided by earnings, is higher than 16 and a half, you may be overpaying. If it's under, you may be underpaying. Well, what's happened is starting on Monday, we entered into earnings season. We're getting Q2 reports of companies. In fact, here is the calendar. On Monday, we started off with Goldman Sachs and BlackRock. This morning, we got Bank of America and Morgan Stanley, followed by a few others. Well, listen to this. Goldman Sachs came out and Goldman Sachs beat their earnings revenue. If you're earning more money as a company, your price should go up to adjust for that 16 and a half. In fact, on Monday, Goldman Sachs stock went up by 2.57%, and today it went up another 2.19%. BlackRock also beat earnings. They went up about 1.5% on Monday, and today they were up about 2.6%. Today, we had Bank of America, who also beat. Their stock price was up 5.5%, 5.35% today. Morgan Stanley did not beat. Morgan Stanley was in line. In other words, they hit guidance. They didn't lose, they didn't underperform, they were just in line with it. Their stock price was still up today, approximately 1%, 0.91. As you can see in my economic calendar here, on Wednesday, we get other big names, United, Crown Castle, which is a big real estate owner. You'll see obviously Prologix is inside of there as well. We get one of our first credit card companies being Discover. We flip to Thursday after the bell. Netflix will be reporting, and we'll also get Abbott giving us kind of a healthcare. What happens during earnings seasons is you kind of get some of the larger companies that are reporting. And when the larger companies report, if they report good earnings, it affects the stock market positively because the feeling is that all the other companies in that sector, smaller than that larger company, also performed well. They also had good earnings, so on and so forth. You'll see American Express is coming Friday before the bell. American Express is a very interesting one. They're the third largest. MasterCard, Visa is larger than them as far as transactions and the amount of dollars. However, American Express is held by many small business owners, and so it can show the health of that small business owner, so on and so forth. And so Monday, we got good earnings out of the bank. That was followed today by some of the investment banks. Don't forget, Bank of America now owns Merrill Lynch. And Merrill Lynch, through 2008, 2009, gobbled up a lot of investment banking. So we saw very good numbers out of the banks. And we'll see where earnings season progresses. But one of the main reasons that we saw stocks do tremendously well, both Monday and Tuesday, is the fact that we have these big companies beating earnings. And when you have earnings that are higher than expected, the price of a stock moves up. Okay, let's keep working here. Say AI, artificial intelligence mentioned in quarterly conference calls. By the way, when companies report, that is public. You can call in via an 800 number and listen to that report that the company provides, discussing what they did throughout the quarter, if discussing what issues that they had, discussing what they see in the future, so on and so forth. I don't have the website up on the screen, but if I did, there's various websites where you don't even need to call in. You can click it and you can participate right on your computer. We typically call in to some of the major earnings calls. And we pay attention to those earnings calls, especially with the larger companies, because it does dictate what's going on in the market. And it also points out what headwinds those companies see. So if corporate profits drive stock prices, and they do, the question is, What drives corporate profits? Well, remember, every company that trades on the exchange is selling a widget of one thing or another. So what drives corporate profits is you and I. You and I going out there and buying whatever widget that they're selling. When I say you and I, that could also include business to business consumption, okay? When we look at that, it's important to figure out what's going on with you and I nationally speaking. In order to do that, we look at an economic calendar. An economic calendar, we have new economic news that comes out basically every single day. The calendar's larger than what I'm showing on my screen, but what I did put on my screen was I put in the major events. So, tomorrow, what we'll get is we'll get building permits. How many new building permits have been applied for? Thursday, we'll get the GDP growth rate quarter over quarter. Friday, we'll get personal income. On Tuesday, we'll see job openings. And Wednesday, we have the granddaddy, which will be, July 30th, July 30th. It's July 30th and July 31st, but July 31st, we'll get the Federal Reserve, Jared Powell, talking again. So we'll have that press conference. When Powell talks, it certainly moves markets. And then, at the beginning of August, we'll get unemployment rates. If I showed you the entire economic calendar, every day is filled with a ton of different events. What I'm showing you on my screen is really over the next 2 weeks, the most impactful economic events. And I'll talk a little bit about how these will move markets. As you all know, and as I've said in my previous webinars, you can see them on our website, you can go back and watch them. The market has really been driven over the last 36 months by the Federal Reserve. What is the Fed going to do? Well, as many of you know, the Federal Reserve has basically three main functions. The first function is to provide an efficient payment system for the United States of America. The second function is to regulate banking operations. And the third function, and probably the most important function, is to set monetary policy. What I mean by monetary policy is it's controlling that federal funds rate. The federal funds rate is the rate at which the Federal Reserve lends to its member banks. The Federal Reserve is lending to Wells Fargo at 5%. Wells Fargo has to turn around and make a loan to you at something north of 5% in order to make a profit. If the Federal Reserve is lending to Wells Fargo at 0.25%, Wells Fargo can turn around and offer you a home loan for 2%, 3%. That's the importance of the federal funds rate. The Federal Reserve moves that federal funds rate around to control monetary policy. What I mean by monetary policy is the Fed has a statement of two goals. They want to see unemployment at 4%, and they want to see inflation at 2%. Well, as many of you know, inflation, since we came out of the pandemic, inflation was boosted by government programs, filling up bank accounts, filling cash up inside of bank accounts. It was also fueled by the supply chain. In other words, things not being able to ship efficiently, and also a ton of pent up demand after the entire world, quite frankly, was locked away inside of their homes. And so if we look at inflation, inflation's been coming down. There's an old saying on Wall Street, you don't fight the Fed. Again, if you attend these webinars or you go back and look at historical ones, I said, and I've been saying for the past 3 years, you don't fight the Fed. When the Fed is raising interest rate, intention is to break something in the economy. Its intention is to see unemployment go up. Its intention is to see inflation come down. Now, when I say all that, you go, yeah, okay, that's fine. Think about what that means. Holistically, that means a slowdown in the economy. You and I, the consumer, not spending as much. If we're not spending as much, what happens to corporate profits? Now, of course, there's answers to that. Companies deal with that by becoming more efficient. Companies deal with that by creating a product that you can't refuse to buy. these types of things. We'll talk a little bit more about that as we move on here. Okay. What you're looking at here is this page shows both headline inflation and core inflation over the last 50 years. Now, core inflation strips out food and energy prices because they're volatile. Well, headline inflation includes food and energy prices. That being said, you'll notice that blue line and that black line follow each other very closely. Headline is in blue, you'll notice it's more volatile, while that black line is core, it's less volatile. That being said, and interestingly enough, the 50-year average as of the close of business on Friday, July 12th, they both averaged out to the exact same thing, 3.8%. By the way, when you think about inflation, think about 2022, as I mentioned earlier. Historically, the worst year on record for the markets, both the bond market and the stock market being down dramatically, with the S&P being down 25 and the bond market being down 13. The first time in history we've ever seen those things happen. Why was that? Well, in June of 2022, we saw inflation hit 9.1%. When you have inflation that high, that takes money out of the consumer's pocket. Why? Because they still have to fill the refrigerator up, they still have to fill the gas tank up, and therefore they don't have money in their pocket to buy a new Apple phone. However, as many of you know, as we went through 2022, as we went through 2023, the most interesting thing was that inflation, if you averaged it out month by month, as I've done in previous webinars and as I've shared with you, was superseded by wage growth. The average American out there got a raise, an increase in pay that superseded that superseded inflation. And in fact, if I go back and I look at June 2023 till currently June of 2024, the even though inflation's been coming down, average wage growth of a United States worker has been 5.58%. Well, headline inflation, that's that inflation that incorporates food and gas. We absolutely want to look at that because it definitely affects the consumer. In other words, over the last 12 months, the average consumer out there has received a raise of 2.19%. This is another reason why the stock market has performed handsomely. In 2022, you may say, geez, what happened? The fear was that the numbers weren't going to work out the way they did. It would be reversed. In other words, inflation's at 9, wage growth's at 3, more money's disappearing to core products, and corporate earnings go down. By the way, that wasn't the case. It's why we had such a V-shaped recovery. It's why 2023 was so great, and it's what is shaping up for 2024. Well, I'll share some more information with you. If I look at the components of inflation, you'll notice here energy, shelter, food, dining, auto insurance, and core goods. People ask me all the time, Derek, what in the world is core goods? Well, examples of core goods are things like automobiles, clothing, housing appliances, things of that nature. And when you look at these types of things, look at where inflation went. As I mentioned, June of 2022, 9.1. Look at where inflation is today. In fact, okay, inflation has, let me find my note here. Sorry about that. I normally know this off the top of my head, but I'm got a million things going on today, so I'm a little rusty and the numbers somewhat new. But anyways, inflation is down at 3. I guess I can see it here. You notice month over month, 3.4, 3.3, 3%. This is another reason why the stock market's doing well. The Fed is getting their way. One of the things about it was when the Fed was raising, remember, they raised over 6,000%. I'll show you that in a moment, 6,000% on the federal funds rate. And we had sticky inflation. We had inflation, even though the Fed was raising, that continued to go up. Well, as I mentioned in those webinars, our economy is 3 times larger, 4 times larger than it was in the 80s. It takes more time to turn that boat. It's not a speedboat. And because of the Federal Reserve's interest rate rising environment, we're starting to see inflation come down. Now, listen, we're still far away from the Federal Reserve's target of 2%, But I'll show you some other indicators of why we're getting there. There is a concern, and the concern is on this slide, it says, how long will inflation stick around? Now, I want you to focus on the word stick, okay? Because there is something called sticky inflation. And what I mean by sticky inflation, sorry about that. What I mean by sticky inflation is things that we don't see going down. You see flexible CPI, that's consumer price index, prices falling, as you can see, but you also see at the same time this thing called sticky CPI. And in fact, while this was rising, kind of saw this plateauing and you don't see it dropping nearly as much. It's very sticky. So what do I mean by sticky? Sticky inflation is housing costs. That includes rent or owner equivalent rent for renters, healthcare costs, educational costs, professional service costs, such as lawyers and accountants, so on and so forth, recreational service costs, like fees for events, fitness memberships, other leisure activities, food away from the house, meaning restaurant prices, communication services like telecom, cable, mobile, so on and so forth. These things, when we look at the inflation report, we look at all the different things like energy and so on and so forth. These are the things that are providing to be sticky. In other words, their prices aren't coming down as greatly, and the Federal Reserve's concerned about that because that can keep the inflation number above their target of 2%, above their target of 2%. And so, of course, we're keeping an eye on that sticky inflation. Let's keep working here, okay? The oil markets. There was an old saying on Wall Street that says, as goes gasoline, so goes the economy. Of course, every day you have a commuter who drives from point A to point B, whether they got to pay $100 to fill up their tank or they got to pay $300 to fill up their tank, they still have to drive from point A to B every single day to and from work. Think of a school teacher. A school teacher has to do that. You know, gasoline doubles at the pump. Well, what this graph shows you, and the reason why I'm showing is energy or gasoline is an important component to consider. Now, of course, prices of gasoline, we saw them come way down. More recently, we saw them go up. We kind of see them kind of stabilize out over the last 60 days around 81 bucks a barrel. But in the top left side of this chart, what it shows is it shows the growth in supply, in demand for petroleum over the past few years, which highlights that while demand has not increased much globally, the supply of gasoline has. The increase in supply has mainly come from the United States of America due to I always mess that up, but shale oil reserves and all the drilling that we did under the Trump administration. Despite inventories depleted more recently, as shown in the bottom left-hand corner, okay, gasoline prices have remained relatively stable. We closed on Friday, national average at 82. We watch this every day. We've been hovering the last 60 days someplace between 80 and 82. Today, I think we closed around 81. What you'll also notice is the number of active rigs. What that simply means is things drilling around the globe has also started to slowly but surely come down, which is natural. When you have gasoline prices that aren't above 100, you start to see rig count go down, which drives prices up. Now, interestingly, I'll tell you something. Under what political party do you think petroleum would do better? In other words, the price of gasoline going up. Most people would say Republican because you notice that Republicans always use the phrase drill, baby, drill. And Democrats, when Biden took office, shutting down the Keystone Pipeline. By the way, this isn't a political webinar. I'm just pointing out facts. Shut down the Keystone Pipeline. We saw oil prices go up. Well, most people would knee-jerk answer that question, Republican Party, drill, baby, drill, so on and so forth. What we find when I look back, under Republican presidents, we see the sector of energy decrease in value because of supply and demand. They produce a lot more oil, and by producing a lot more oil and petroleum products, price of oil goes down. When the price of oil goes down, those companies that exist in that oil patch, ExxonMobil, Phillips, so on and so forth, also tend to go down. Anyways, let's keep working here. The labor market. So again, I go back to what drives corporate profits, and what drives corporate profits is you and I out there spending things. So what's going on in labor? As you know, for the past almost 3 years, that number of unemployment below 4% has been below 4% almost every single month. We had a big spike up during the pandemic, and then what we had was this crazy labor market. And the labor market continues to represent resilience. That being said, if I flip to my next chart and still talk about the labor market, this looks at JOLTS. JOLTS just stands for Job Opening and Labor Turnover Survey. You may remember back in March of 2022, it wasn't too long ago, I was saying to you, for every unemployed person, there was like 3 or 4 job openings, right? The labor market was so strong. Unemployment was all the way down at like 2.3%. Well, interestingly, when you raise interest rates, what does that do? It costs businesses more money. When that costs businesses more money, they go, hey, maybe instead of having 3 job openings, we only have 1 or we only have 2. What you've seen is the number of job openings come down substantially. That being said, the number of job openings compared to historical numbers is still extremely strong, okay? We peaked at a record of 12 million job listings opening in March of 2022. We're falling back to more normal levels. However, as I mentioned, openings are still well above historical trends. This may suggest some sort of buffer in excess labor demand that is keeping unemployment low. It's kind of a mixed bag because when you have that occurring, what happens? You still have companies out there looking for people to come and work there. What do they need to do? They need to raise how much they're going to pay that person to attract them. That's inflationary in and of itself. But what we're also seeing is, look at quits. We see quits coming way down. If you remember from previous webinars, I was saying that's weird. You saw all these high quits, but you know what you also saw was you saw no layoffs at the same time. And guess why people were quitting? They weren't quitting to quit because they didn't want to go to work. They were quitting because they were going, hey, if you're an engineer working at Exxon, they got a call from a headhunter and they said, you're an engineer working at Exxon, you make $250 a year. Hey, come over here and work at Anadarko and we'll pay you $325 grand. I have clients that do that for a living, that are headhunters, and they were going gangbusters, a year and a half ago. I talked to them. Things are slowing down substantially for them. And this is why you see the number of quits going way, way down, or at least one of the reasons. Also, not as many job openings, right? Those kind of go hand in fist. And layoffs, you see layoffs picking up. Let me give you an update. We just got this data. Unemployment is now above 4%. We got the new data for June. Unemployment went up to 4.1%. Now, that doesn't sound good on the surface, and I agree. When you have unemployment that goes too high, okay, when you have unemployment that goes too high, how do companies make profits? People aren't working. That being said, when you look at the whole bag, the labor area is still extremely strong, well above historical job openings, okay? And this is yet another data piece that helped propel the markets in July. You had unemployment that finally hit the Federal Reserve's goal of 4%. We're at 4.1%. Okay, we're at 4.1%. It can get dangerous, but at least right now, and I'm going to give you some predictions as we keep working here. So how's the consumer doing as far as their finances? On the left, we show you the total assets and liabilities of US household. Consumer balance sheets held up remarkably well during the pandemic, thanks to massive fiscal support. On the top right, we show you household debt service ratio. What this is a percentage of after-tax income used to make payments on things such as mortgages, rents, and other consumer debt. After declining to a 40-year low during the pandemic, sorry about that, after going down to a 40-year low after the pandemic, and the reason why it went down so low is, think about it, you could refinance your house at a very low rate, okay? All those credit cards, because the Federal Reserve brought the federal funds rate down to 0.25, all of a sudden that APR on credit cards that were at like 26 came down to like 14, so on and so forth. And so what you can see is, although we get a 40-year low after the pandemic, the Federal Reserve then started tightening, and we see now, you know, Q2 2024, we still have about 10% going to pay for those debts. On the bottom right, we also show you something very interesting. We show the flow of auto and credit card and student loans in 30-day delinquency. During the pandemic, obviously there was forgiveness, so on and so forth, and there was all these rate adjustments and what have you. But if you notice, what we've seen is we're seeing a big uptick in delinquency on auto payments, on credit card payments, so on and so forth. Now, if you think about it, all this stuff goes hand in fist, right? You saw unemployment tick up to 4.1, not a bad thing. You're seeing wage growth, but by the way, wage growth has come down. It's still beating inflation, but it's come down. And in addition to that, when it comes to student loans, remember this, I'm hearing this from people's parents. Hey, this student loan didn't need to be paid. It's been 2-3 years. All of a sudden, the kid's now spending all of their disposable income. Maybe they went out there, they bought a car, they rented an apartment or bought a house. And now all of a sudden, they're getting news, hey, you got to start making $400 payments on that student loan. If there's no extra meat on the bone, you would see delinquency goes up. And this is somewhat concerning. We start to see that when things start to soften. So that's one concerning point. Consumer saving. This page takes a closer look at the health of the consumer. On the left, we show the personal savings rate, defined as personal savings as a share of your disposable income. During the first years of the pandemic, the savings rate skyrocketed as the shutdown in activities and large fiscal transfers filled consumers' wallets, right? People were sticking at home, and people were getting money from the government, and they weren't spending money on gasoline, so on and so forth. However, as businesses returned to normal, pent-up consumer demand and rapidly rising prices forced consumers to draw on their excess savings and fund their spending habits, causing the savings rate to fall below levels. You can see that on the left-hand side. And the top right-hand chart shows how excess savings peaked during the pandemic and are now on their way back down to pre-pandemic levels, as personal savings rates have also fallen. And in the bottom right, we show you how savings have decreased over the past few years. The majority of savings are concentrated in higher income groups. Well, you may say, hey, Derek, that's fantastic because people are out there spending that leads to corporate profits. That's right. You are correct. But the concerning thing about it is, right, you got 100 grand in the bank, you go out there and you blow 90 of it, you don't have the 90 anymore. So maybe you did go out there and buy a new car. Maybe you did go out there and buy a cell phone. Maybe you did go out there and bought the this, that, or the other thing. Okay. Where will that excess spending come from in the future? And in addition to that, as rates have gone up, think about people that have credit card debt. They went from a minimum payment, let's say at $200 a month, and now all of a sudden their minimum payment's $500 a month because of where interest rates. Think about folks who lease cars. Literally for the last 20 years, if that person had leased a car every 3 years and they always leased the same car, they went in there and because interest rates were so low for so long, when they went in, the price of car went up a little bit, but they went in there and let's say they were paying for at least $300 a month. They went in there 2 years later, 2 years later, 2 years later, the people in the car say, hey, listen, it's only $320 a month, $340 a month, 6 years later, no big deal. This time when they go in there for the same exact car, because of where rates are, hey, it's not $350 a month, it's $650 a month, okay? All right, let's keep working here. Consumer sentiment. Consumer sentiment, basically, as many of you know in the webinar tonight, as many of me have heard you said, the University of Michigan reaches out to thousands of households and they ask them questions about how likely they are to take a vacation, how they feel about the economy. And what happens is they plot this thing, and what it's called the Consumer Sentiment Index. The Consumer Sentiment Index has an average of 84.6, okay? The dots that you see on the screen below the average indicate in any particular year what some of the lowest readings were. Now, interestingly, a lot of you will remember me showing you this in June of 2022. You can go back to the webinar and look at it. It was the lowest reading for consumer confidence in history. We had a reading that was like 48. Now, interestingly, the number below it points out what the S&P 500 return was 12 months later. And you probably remember me saying, hey, nobody can predict the future. But if you look at this chart, look at this. I mean, August 1972, big consumer confidence number. Everyone was feeling great. Look at what happened to the market when everyone was feeling great. August of 1972 to August of 1973, S&P 500 down 6.2. May 1977 to May 1978, right? High consumer confidence number, market was only up 1.2. Yet look at all these, when people are feeling crummy, when people are feeling their worst, look at those rates of return. It's incredible. And then look at the rates of return when you see strong consumer confidence, right? So we just got July's consumer confidence. It was relatively low at a 66. Not a bad thing, at least historically when we look at it. Interestingly, I threw this in here. Consumer sentiment by political party. This chart shows a survey from the Pew Research Center asking Americans, both Republican and Democrat, how they feel about economic conditions. It's of no surprise that Republicans often feel better about the economy under a Republican president, while similarly, Democrats often feel better about the economy under a Democratic president. The reality is, when you look at the S&P growth, so on and so forth, Bush, Obama, Trump, Biden, even if you take that out further, there seems to be no huge correlation. Listen, Washington policy does do things over the long term. One of the biggest things is tax and regulation. That being said, there's bigger driving forces in the overall market than who's in office is, I think, what we're trying to point out there. Unemployment and wages, we kind of hit on this, but this chart shows the unemployment rate and wage growth for production and non-supervised workers since 1960. The two measurements have an inverse relationship, obviously. So when you see unemployment go up, wages tend to come down. I mean, you know, that goes without saying. We're seeing that happen today, as you can see here, right? We're seeing unemployment. We're also seeing wage growth come down. These are showing you the 50-year average. I showed you the 12-month wage increase at about 5.8%. Let's keep working here, okay? We talked about the job market. I just wanted to come back to it for a moment just to say and to reiterate, we're seeing that softening in the economy. We're seeing that softening in the labor force, okay? When we look at labor supply, as I mentioned earlier, right? Because, you know, even though there's all these jobs that are open, one question that you may have is, hey, who's there to fill those jobs? Well, remember, we're going through all those baby boomers retiring, and a lot of those baby boomers put off retiring. Some of them put off retiring because of what happened in '08. People got blown out of because of what happened inside of the stock market. People put off retiring, or some did retire during the pandemic, but they were going, hey, listen, I'm kind of at home taking it easy. They're still paying me. That being said, okay, we have, you know, a labor market. We do have the workers to fill those jobs. That is a good thing. You look at other countries such as Japan, so on and so forth, they don't have the labor market. During the pandemic, one positive thing about it was we had a baby boom type of thing happen here in the United States of America. And the reason why that's important is you need labor to fill those jobs. We have a participation rate that's been the best since the 50s. So more people are working, so on and so forth. So where are we now? We're getting to the end here, folks. I hope you've enjoyed it, but we're getting to the end. I'm going to give you some predictions. This is what most people like inside of the presentation. I'll give you a quick update on things. I'll give you some predictions. Let's take a moment to consider the variables that may weigh the heaviest on market performance. We believe the factors that led to the first half's market performance may remain critical to how the market behaves in the second half. Remember, the first factor is inflation. One of the reasons that has really driven the market through 2023 and the beginning of 2024 was the fact that inflation was coming down, and the Federal Reserve had indicated, if you remember, at the beginning of 2023, hey, we'll probably, or at the beginning of 2024, we'll get 7 rate cuts. That then became 5 rate cuts. That then became 3 rate cuts. Here we are. It's almost the beginning of August. Maybe we get 1 to 3 rate cuts. Okay, I'm under the opinion that we will probably see 1 rate cut, and we will probably see it in September and October, and I'll explain why in a moment. But that sticky inflation, the Fed's going to be very hesitant to make a rate cut, especially with that sticky inflation kind of hanging around. The Fed's going to be very hesitant to make a rate cut, okay, a rate cut when they don't have inflation at 2. Remember, inflation's at 3. Yes, unemployment at 4.1, but remember, it just touched there. And also remember that unemployment was well below 4% for basically the last 2.5 years. And so the Fed's going to be very hesitant. That being said, and on top of that, the labor market, I showed you the labor market still being very strong, although weakening, okay? The reason why I say only 1 is because the Fed is going to be hesitant. Obviously, we'll get Powell talking at the end of the month, and he'll probably say what he's been saying since last July. He's been saying, hey, listen, the effects of our interest rate rising activity has had the effects that we've wanted it to have, and we're starting to see those effects come home. Now, listen, if unemployment goes up, if all of a sudden we see unemployment shoot up to like 4.7, 4.8, 5.1, something like that, we'll get that rate cut sooner rather than later, and we may even get 2 rate cuts because they are trying to produce that soft landing. They don't want to see unemployment shoot way, way up. So the Federal Reserve, I think, is going to come back into the picture, okay, very strongly. An update. As of the close of business today, you may remember I showed you where markets were at the close of business Friday. Today's Tuesday. Look at this with me for a moment. NASDAQ, 21.23%. Now, the NASDAQ really didn't participate today in the market. It was basically flat, but over the last 2 days, we added about 1.5% to the NASDAQ. S&P 500, non-equally weighted, added about a point. Russell, 2000, that is small company stocks, over the last 2 days has added almost 7%. If I go back to Friday, it was up like 6.5 today. Last 2 days added like 6%, 12.5%. Dow Jones Industrial Average added about 3, and the equally weighted S&P 500 has also added about 2 points to it. Now, seeing is not believing. You've all seen this, but ask yourself, which circle is bigger? Which one? Answer it in your head. Which line is longer? Answer it in your head. And are the gray lines parallel or are they squiggly? Most of you have seen stuff like this, but record your answers before I give you the answer key. Obviously, they're the exact same size. The lines are the same, and these lines are parallel. Can you believe that? You wouldn't have guessed it. Let me show you some more data. We talked about PE ratios. When we talk about PE ratios, it's like anything else, right? We talk about bubbles like the tulips, and we talk about bubbles like we've seen bubbles in certain industries, like, you know, maybe a Bitcoin or cryptocurrency, so on and so forth. But when we look at PE ratios, where we were on July 12th is we had a PE ratio of 21.5. 21.5. Okay. By the way, the PE ratio today, 27.5. In other words, the price of stocks have gone up. Earnings have been okay. Now, every time that we've gotten one standard deviation above that 16.5 on a PE ratio, look at this, January 3rd, 2022. I gave you a whole bunch of reasons why the market performed poorly in 2022, mainly the Federal Reserve raising interest rates. But my point here is I don't care what the reason is. There is a Fibonacci retracement, which I won't go into and explain. I'll explain it like this. Everything reverts to the mean. You take a rubber band, you pull it, it reverts to the mean. I'm not going to say why things revert to the mean. I'm just going to say everything reverts to the mean. So look at this, January of 2022, P ratios 21, reverted to the mean. We had a 25% drop inside of the market, as you all know. Of course, quick recovery from there, but here we are, P ratios back to 21, in fact, a bit high, as I mentioned, 27.5, especially over the last 2 days. Look here, February 19, 2020, P ratios 20, big correction in the market, down 34%. When we see reversion, when we see movement away from the mean, we tend to revert. Worried about that. That being said, keep working here. When we look at the sectors of the S&P 500, look at the technology sector PE ratio. That's the last 12 months. This is forward. Healthcare, last 12 months forward. Real estate. There are some areas that show attractive PE ratios, such as energies and financials. When I say attractive, I mean from a price to earnings standpoint. Everybody likes to buy things on a discount. Everything reverts back to the mean the other way. Remember, emotional investing. The last few days have been fantastic. You see markets going up, you're confident. They go up even further like they did today. I mean, the Dow is up 700 points. You become, just enthralled. And you say, geez, I'm going to quit my job. I don't even need to work anymore. And all of a sudden you start to see things start coming down, nervous, what's happened, what's going on. And all of a sudden things continue to go down. You're desperate, defeated, and then things start to come back up. That's quite frankly just the economic cycle. What you notice here is riskiest time, best time. When things are very utopic, there's one rule when it comes to investing. You never, ever go broke on taking a profit. And there is nothing wrong with ringing the register. Economic cycles always happen. Nothing goes up forever, just like nothing goes down forever. When is it time to sell? This chart shows you the exact same thing. I will answer that question of when is it time to sell, but I will keep showing you here. I will keep explaining it here. You know what? I'm going to answer that right now. I'll go back to P ratios. From what I just showed you from the P ratio graph, you would say to me, I'm looking for something, but you would say to me, well, Derek, this seems like things, are way overbought. And look, you're right. Last time we were at 21. Here we were at 20. That's a standard deviation above 16.5. It's time to sell. Well, two things happen with PE ratios. Two things happen with PE ratios. Either when you go through earnings season, which we just started on Monday, you have earnings that come in and companies aren't beating their earnings, okay? And when that happens, definitely see the market sell off. But just because PE ratios today are high, what if earnings go up? Well, if earnings go up, which we'll see unfold over this week in the coming weeks as we go through Q2 2024 earnings, if earnings go up, right, and the stock market doesn't go up 700 points every day, P ratios will adjust on their own. In fact, and I won't go into it tonight, but there's this whole philosophy that stock prices don't come down to adjust to PE. Company earnings go up to adjust to PE, if that makes sense to you. But of course, that's in the data. That's why we look at what's going on with the consumer. That's why we look at what's going on with company earnings. That's why we look at what's going on in the different industries. That's why we look at what's going on inside of the employment markets and unemployment markets. If I come here and I look at economic growth, it's a variable of how market performance is coming in current quarters. That being said, in May of 2024, they do this about every 6 months, the Federal Reserve of Philadelphia put together their consensus forecast looking at 3 key economic factors. Those 3 key economic factors are GDP growth, which we get in a day or two for Q2, unemployment, and inflation. When the Federal Reserve of Philadelphia looked at this, this is where the consensus came in at. They said that as of May of 2024, they believe that they will see GDP growth between 1.5 and 2.4 through 2024 and into 2025. That is very good. That is very good. They also expect to see inflation. It should be of no surprise that they expect to see inflation come down to 2% and kind of remain between 2 and 2.4%. Interestingly, they just did this a month ago, a month and a half ago. They see unemployment remaining low between 3.7 and 4.2. They don't see unemployment going up too much more from where it is today. If that were to persist over the next 18 months through 2025, and the Federal Reserve of Philadelphia is correct, it very much creates what the Federal Reserve is trying to create, a Goldilocks scenario. Not too hot, not too cold, not too hot, not too cold. Remember, headline risk. If we remain in this Goldilocks area, in other words, kind of where we are today, wage growth still above inflation, Federal Reserve able to keep their gun loaded with their federal funds rate at 5.5%, so on and so forth. Markets will continue to kind of chug along, will continue to do well. Companies are also becoming more efficient because of technology. Okay, but that's where the Federal Reserve of Philadelphia sees things. When we look at earnings, buybacks, and dividends by sector, this slide looks at earnings, growth, buybacks, and dividends. The top chart shows sector-wise earnings growth as represented by year-over-year change in pro forma earnings per share. Many sectors of the S&P 500 were beat up through 2023 and 2023. In a few sectors, mainly technology, consumer discretionary, that's consumer discretionary is just paying for, it's the discretionary dollars that you have, and communication services, again, I'll call that technology, drove a bulk of the earnings growth in 2023. However, a broader earnings recovery is underway. We're starting to see earnings per share, okay, go through all the sectors of the S&P 500. Remember, earnings, when it comes to a company, is one of the number one driver of stock price, quite frankly, the number one driver of stock price. When companies have earnings, they tend to pay out larger dividends or increase their dividend, And at the same time, they tend to employ share buyback. They buy some of the company back, which also pushes up stock prices. These are the forecast as we get into, forecasting Q2, Q3, and Q4. And so that's positive news. I'll give you my 2 cents in a second. Okay, I'm going to skip that slide. This is just another slide of what I showed you earlier. People like to see things visually in a few different ways. So if we look at all 11 market sectors, we show earnings growth showing up in 2025. And if you take a closer look at this chart, you'll notice that 6 out of the 11 sectors of the S&P 500 are expected to grow compared with their earnings today. We don't see negative declines, but better returns. Interestingly enough, when we look at this, information technology, you'll notice here's today, here's future. You'll notice that that is expected to slow, but you'll see areas such as financials and energy, consumer staples, in consumer discretionary, as people kind of, hey, I'm not unemployed, I'm not part of the unemployment numbers, assuming the the Federal Reserve of Philadelphia is correct. Now, this is actually what I was looking at before. This is going back. This is from 94 until current date, close of business on Friday. There you go, 30-year average on PE ratios, 16.7. By the way, if I go back to 26, average is 16.5. Again, as of the close of business on Friday, P ratio 21. There's that one standard deviation. We get above 20. It's very difficult to buy markets down there when we have at least below the one standard deviation. We don't necessarily get things this big of a discount. It only happens during recessions. Even during the COVID quick V shape, we didn't even go one deviation below. So we don't get stuff on sale like we did in 09. We don't get stuff on sale like that too often, but you can buy around here with some economic numbers, but we're pretty high today. And so I'm making my point here. As many of you know, I've showed you on our trading screen, this is an algorithm that we've done ourselves. These are Japanese candlesticks. This is the S&P 500, dictated here with ticker symbol SPY. Where you see the green, those are buy indicators that I get. Where you see the red, those are sell indicators. You'll notice the S&P 500 hit a high right today. There you go, 163. There we were today. But you'll also notice that I got a sell indicator on the S&P 500 almost 3 weeks ago. Why is that? We look at something called relative strength, or RSI. When we look at RSI, relative strength is just a momentum oscillator. It's a technical analysis tool that we use. And what we say is, hey, listen, when things are below, sorry how that chart looks, you can't even see what I wanted to show you, but when things are below 40, we try to look at them to buy. You would see buy indications when we have below 40, and when things go above 70, it's typically time to sell. Things tend to revert to the mean. What I mean by that is these green and red things here, they're called Japanese candlesticks. The blue line, the yellow line, the white line. The blue line is a 50-day moving average. The yellow line is a 100-day moving average, and the white line's a 200-day moving average. What I mean by moving average is just the closing price of the S&P 500. Typically speaking, you have the Japanese candlesticks that kind of hold around that blue, yellow, and white line pretty tightly. And then sometimes you have some huge reversion from the mean. And as I mentioned, when you have huge reversion from the mean, for whatever the reason may be, I could go back and pinpoint all of these reasons for you, but for whatever the reason may be, you tend to have reversion to the mean, meaning those Japanese candlesticks tend to start to group back down someplace around those lines. Okay, we're at basically the last slide. This is another very important indicator. It is the yield curve. As many of you have heard me say, Sir John Templeton once said, the 4 most expensive words in investing are, "This time it's different." And normally I would always agree with that. However, this time it may seem like that phrase This time it's different. It may actually be that in 2024, it is different. What I mean by that is this. If we go back to 1976, okay, every time that we've had an inverted yield curve, what do I mean by an inverted yield curve? All that it means is this. If you lend money, you, the investor, lend money out. If you were to lend money out to somebody for 30 years, you would expect to get higher interest. In other words, if you're going to lend money out for 30 years, you might expect to get 9% interest. Versus if you were to lend money out for 3 years, you would expect to get lower interest, call it 6% interest. That is a typical yield curve. Just think of a line going up. An inverted yield curve is when the exact opposite happens. In other words, you're getting 9% to loan money out for 3 years, and you're only getting 6% to loan money out for 30 years. What does that tell us? That tells us that there's trouble in the short term, right? More trouble in the short term. Since 1976, every time we've had an inverted yield curve, that's tend to lead to recession. It's tend to lead to the economic cycle that I was explaining. The yield curve, by the way, has been inverted since 2000. We started to see the inversion since 2021. Interestingly enough, we were kind of flat, as you can see there, and positively, we're starting to see that turn a little bit, but we've seen it kind of turn in the past just to re-invert. The yield curve, you can't argue with it. I mean, for whatever reason, it has literally predicted every recession since 1926. However, is this time different? Listen, when this went inverted back in the beginning of 2022, everybody was predicting a recession. Everyone was predicting unemployment to skyrocket up. Everyone was predicting things would get nasty. They didn't. So maybe this time is different. What's ahead for short-term rates? The biggest question investors have is, where's the Federal Reserve going to go? The federal funds rate, effective rate, is 5.33% currently right now. Remember, we have the July meeting, concludes the 31st. We'll get the speech from Powell. I don't expect a cut. They're going to wait and see. Next meeting, September 17th and 18th. On the 18th, depending upon what happens with unemployment, okay, and inflation, we may get a cut. But then that's followed by November. We get that November meeting right at the beginning, November 6th. Powell comes out on the 7th. It's always a 2-day meeting. And then the last meeting is December 17th and 18th. Will we get a cut? Listen, everybody wants us to get a cut, but I will also tell you this. When we get a cut, everybody thinks, oh, the stock market's going to go crazy. Why? Because when you bring down rates, that should lead to greater profits because companies don't have to pay as high interest on any debt that they have. However, if you go back and you look at the first interest rate cut that the Federal Reserve typically does, markets sell off 8 to 15%. Why do they sell off? Because what the headlines say is Fed sees more trouble ahead. Why does the Fed cut? The Fed only cuts to stimulate the economy. In other words, unemployment did go up to 6-7% or something like that, something the Fed didn't intend to do. The Fed would love unemployment to hover right around this 4. That would be the soft landing. Okay, so if we do get a rate cut, I hope we don't get a rate cut. Now, I know for those of you who do lending and want to buy a house or refinance, a rate cut would be helpful. I'm not rooting against you. I'm just saying, right? I'm just saying if we do get a rate cut, that can be because things got weaker than expected, which would spell some trouble. Not going to cover this, but most of you know, bonds, so on and so forth. And the only point that I was making here is, right, worst year in the century for bonds, 2022. And I said earlier, the Federal Reserve brought up rates by 6,000 some odd percent. Listen, March of 2022, the federal funds rate was 0.08, 0.08. That's why some of you have mortgages at 2.5%. A year and a half later, July 2033, that was the last rate cut that the Fed did. But the federal funds rate at that time was 5.33. It was a 6,562% increase in the federal funds rate over a year and a half. It's why you saw bonds get decimated, okay? Fundamentals. Listen, markets, although everything that I brought you through over the long term, they do fantastic. This is showing you the markets from 1926 until current date. Have you invested $1 inside of it? You have all that volatility, but things sure did grow. I know we're kind of running lengthy here. This is showing you how time is on your side. What this is showing you is if you were only willing to invest for 1 year and you go back, okay, to 1926 until basically current date, you're only willing to invest for 1 year, 74% chance you made money, 26% chance you lost money. However, if you then look at 5-year periods of time and 15-year periods of time, which are what these next two graphs are doing, and what I mean by 5-year periods and 15-year periods is they looked at every single, all the different 15-year periods that would fit into that time frame. And listen, if you would hold for 5 years, an 87% chance that you made money by investing, this is looking at the S&P. And by the way, if you held for 15 years, there's never been a time, if you put money into the S&P, closed your eyes and waited 15 years, never been a time that you have lost money. So that is something that I would say. In the essence of time, I'll skip this chart because it has a lot to do with what I just said. I was going to talk a little bit about fad investing. Obviously, we see AI. You can see the different fads that we've identified since 1977. It always is wise to have some sort of asset allocation. As many of you know, it softens the blow. People don't get this, but if you have $1 and you lose 50%, you're now left with 50 cents. If you not, so you lost 50%. If you have a gain of 50%, you're not back to $1. You're only back to 75 cents. In other words, losses have a greater effect than upside, as I just mentioned there. If what I said to you today really scares you, you'd be interested in seeing this. This is showing you different asset allocations. This is called an efficient frontier. This is showing you somebody who's 100% in bonds, bonds being very conservative, low risk, so on and so forth. This is showing you somebody who's inside of a portfolio that's 60% stocks, 40% bonds. Down here you have risk, up here you have return. What you will notice is, in fact, the portfolios that hold some equity inside of them, look at that, less risk than a portfolio that has 100% bond and greater return and greater return. I could unpack that for you further. One last slide I'll leave you with, and then I'll leave you with some personal projections, is listen, rates are coming down. Money markets not too many months ago paying 5.5%. Rates are coming down. So if you're sitting in your bank account, if you're sitting in a money market, and you're happy earning that 4.5%, 5.5% rate of return, that's fantastic. But realize this, the reason why you're earning that today, and we're not earning that over the last 20 some odd plus years, was due to the fact of where federal funds rates were. Although I said that I hope that the Fed doesn't cut rates, although I said that the economy could be in this Goldilocks economy over the next 18 months, so on and so forth, based upon a number of economic factors as well as earnings reports from companies, okay? Eventually, the Fed's going to start to cut rates. Eventually, it's just the economic cycle. It's just the economic cycle. That money market that you're sitting in, that bank account that's paying you, whatever the case may be, that will automatically come down. You have a chance where you can lock in today. What I mean by lock in is you can buy short-term fixed income securities, CDs, short-term bonds, so on and so forth, and lock in 5+% and not worry about that rate coming down. To give you my projections, listen, I was quite surprised the market was up 700 points today. To give you my projections, I do not like PE ratios at 27. I just don't. I've seen it happen a million times. I've been through it a number of times when we have markets that just are not giving up. That being said, if I look at the backdrop of the labor, if I look at the backdrop of wage growth, if I look at the backdrop of inflation, if I look at the backdrop of the consumer who drives all this, things are pretty darn strong. Everybody refinanced basically, through the pandemic. Wage growth, job openings are still there. Can we stay in this Goldilocks environment? It's amazingly difficult to do so. The Federal Reserve, even with their interest rate playing policy, some of it's self-fulfilling, but it would be good to see. What I can tell you is this: we are paying extremely close attention to the data. We are looking at these earning reports. We're trying to get a feel for it long before they come out. We pay attention to all of this stuff. This earnings report, at least from what we're seeing here, should be pretty strong. We've seen the banks come out. We'll get real estate that comes out, so on and so forth. So I'm pretty bullish, and that's what's driving the market today. Once we get through earnings season, the talk's going to be the economic data, and we'll see where the economic data comes in. I think right now it's not time to be overly bullish, as you noticed through my chart, right? The time of most risk. You can never call a top exactly at the top. It's just impossible to do. It's just impossible to do. But we've seen wonderful returns over 23. We've seen great returns now in 2024. There are pockets, there are investments that look very attractive. There are segments that look very attractive. I hope Powell can keep us in this Goldilocks. I think that we will probably have some sort of a sell-off for whatever reason. I'm not going to try to predict the reason, but what I am going to try to say is things do revert to the mean. That sell-off with the data that we have today, I think will be short-lived and won't be anything greater than a 6 to 10%. It'll be based upon that economic data, and it'll be based upon corporate earnings, which we're obviously paying attention to. You know what we do. So until next time, sorry, I always go over, I'm lengthy. I could go on for another hour. Triumph Capital Management, sorry about that. Triumph Capital Management, for those of you who don't know me, again, Derek Eichenwald signing off. For those of you who would like copies of this presentation, you can email info@triumphcapitalmanagement.com and you will get these slides if you'd like them. You can also visit our website and you'll be able to view this webinar. And for those of you who registered, you will get a recording of this webinar emailed to you if you didn't attend live tonight. If you have any questions, obviously we don't have time to open up for those. We went over and there's a lot of people inside of the webinar tonight, but if you have questions, please reach out to us. Happy to answer those questions one-on-one. If you'd like to chat about anything that I mentioned tonight, obviously everything that I said tonight was a 50,000 foot overview. There's a lot more to the story. It's just that on any one of those slides, I could talk about it for an hour in and of itself. Again, thank you all so much for joining. Thank you all for entertaining this. Thank you all for paying attention to our views and our standpoints on things. Thank you and have a wonderful evening.